and welcome back to another episode of Wealth and Wisdom. I am Kenny Polcari, your host, and today, once again, I am bringing Tony Sagami on board. Now, if you don't know who Tony Sagami is, then you really need to read up because he's one of the few tech analysts who helps investors in both up and down markets. He has been twice named Portfolio Manager of the Year by Thompson Financial, and he's been at Weiss Ratings for more than 25 years, right? He has helped develop one of the first issue buy signals here at Weiss on a model of 25 tech stocks that would have grown from 250,000 in 2004 to more than $6 million today. Tony is the co-editor of Disruptors and Dominators, and that's one of the products that I want to talk to you about today because that is a very interesting and dynamic product. And Tony, as always, it is a pleasure to talk to you. Welcome back.
Well, thank you, Kenny. I have been at Weiss for a while. You know, I've been there so long that when I first started working with Martin, we both had black hair and more of it.
I hear you. Isn't that true? Isn't that true? I remember those days when I had black hair as well. Well, that's great because you've been here for more than 25 years and you've written this piece, this subscribable piece, Disruptors and Dominators. So tell the audience a little bit about what it is so that they become a little bit more familiar with you and the style.
Well, I think there's never one way to invest in the stock market. There's always at least two. And that's why I have Disruptors and Dominators. The Dominators are those big, established, profitable, steady blue chip companies that do well. Right. They do well. They're not going away. They're going to be here for a long time. They're steady, stable, often pay dividends, and they should be the core of any investor's portfolio. However, the really big home runs are often found with new disruptive technologies. And it doesn't necessarily have to be a technology. You know, Costco disrupted the entire retail space.
Amazon disrupted the retail space.
Yeah. Federal Express disrupted package delivery. And so disruption is a very profitable process to invest in if you can identify the correct ones. And by the way, if you find the right disruptor, they become a dominator down the road, just like Amazon, Costco, UPS.
Because you wouldn't necessarily refer to Amazon anymore as a disruptor. Now it's a dominator, or is it both still?
Oh, it's really a dominator, but it's doing new things like their cloud storage is their fastest growing division. Yeah. That definitely was disruptive for the entire storage and energy. Yeah. And they're also making investments into drone delivery, autonomous driving, and all kinds of things that are still going to drive its profits in the future. Right. So it is a little bit of both, and that both is a very, very good thing to have on your side.
Both is a very good place to be, actually. And Amazon, like you said, I think Amazon is one of those foundational names. You should own it. And it's backing off, I actually think they're giving you a gift right now. The stock was down over 40%. Well, coming into today, the market's going to rally like crazy today, but it was coming in down 40% on the year. I got to tell you that's a gift, in my opinion, for the long-term asset manager.
There's a lot of gifts out there in the tech sector. Some of them have been hit pretty hard. Yeah. Some deservedly so, but some not so much deserved. The first thing I do every day when I wake up, Kenny, is I open up the Wall Street Journal and I take a look at the 52-week new low list.
Right.
The new lows, not the new highs. I take a look at the new highs, but I really pay attention to the new lows.
Right.
Because that's where you find bargains. Whether you go to Kmart, they call it the blue light special. My father used to say, buy your straw hats in January. Right. What that means is you want to be cheap. And for me, I'm kind of a cheapskate and a chicken, and buying stocks have been beaten down like Amazon recently is one way to be cheap and chicken.
Well, why do you say it's being chicken? I actually think it's being cheap, yes, because I think it's an opportunity, but I don't necessarily think it's being chicken. I think it's being aggressive, right? If you're buying Amazon down here, I wouldn't define it as being chicken. I'd return it as an opportunity.
Yes, I agree. But, human nature, investors have always bought high and sold low. It's just part of the perverse psychology that dominates our emotional investment style. That's wrong.
To your point, that's exactly why you should not be an emotional investor. And if you are an emotional investor, then you should work hand in hand with an advisor that's going to keep you on track. Because the last thing you need to do is be emotional.
Yes. And speaking of emotions, let me talk about this chart that I sent you. It shows the put call ratio
Right.
going on now between the puts are people are making bets that the market's going to go down, and
Right.
the call is a bullish bet. And look at this put call ratio. It's 4.2 to 1. And actually, that is an all-time high. That means that the professional speculators are overwhelmingly by 420% buying more puts than calls.
Which means they're more
extremely
bearish. Right.
Very bearish.
And so that in itself is a contraindicator.
You know, I consider myself kind of a contrarian. I don't like to run with the crowd.
Right. You
know,
never did.
No. You know, I've seen more independent thinkers in a flock of sheep than I have in Wall Street. And so when I take a look at when these guys are dogpiling to the extremes, this isn't just 100% or 200%, that's 420% more. That's
Right.
an extreme amount of sheep following. And so that tells me that there's some contrarian opportunity on the
Yeah, on the other side.
yes. You know, which take a look at what the market done. You know, since the late October, the S&P 500 is up more than 20%.
Right.
You know, that's a definition of a bull market, isn't it?
It absolutely is a definition of a bull market. And as a matter of fact, they talked about the Dow was the first one to make that move, right? So the Dow was in a confirmed bull market just a couple of weeks ago when it made that transition. I'd have to go back now and see if the S&P, actually after today, the S&P is probably now going to be defined as being back in a bull market. Off the lows that it created back in, let's just see, it created the low back in October. So let's just see what that move is based on this morning. We are up 17%. So we're still not in a bull market yet.
Oh, okay. What the Dow is.
The Dow is, but the S&P and the NASDAQ are still just below. We're getting there, but not yet. So Tony, let's go ahead.
Well, that's kind of, I think most people would be kind of surprised by that because the Fed has been raising interest rates.
Yep.
There's all kinds of gloom and doom out there. People are worried about tech job cuts. Real estate prices have been falling a little bit. There's all kinds of reasons to be worried.
Yep.
But the thing that you don't need to be worried about as much as the Fed. The Fed is not done at raising interest rates. They're still going to raise rates, but the pace is decelerating, and
Right.
we're getting closer and closer to the time where there'll be more of the friendly Fed again. There's this other chart that I sent you. Take a look at the Fed expectations. You can
Right.
see that they're looking for a much slower pace of rates in 2023. And remember, the stock market is a forward-looking cash register. It's
Right.
looking 6, 8, 10 months in the future. And so they're really excited about what the Fed's going to do, not next week at their meeting, but in the 6, 8, 10 months. And as this chart shows, the expectation is that Fed is going to become very friendly again. And look at some of the words that came out of Jerome Powell's mouth. He said, the full effects of rapid tightening have yet to be felt. And it makes sense to moderate the pace of increases.
Right.
And then he said, moderating the pace of increases could come as soon as December.
Right.
And so he's given you unambiguous
Right. I think
message.
he's been very clear, right? So I think the rate hike that's coming in December, that came on the 14th, it's going to be a 50 basis point hike, which is down from 75. So yes, the pace is moderating. But like to your point, he told you that's where it was going. He could not have been any clearer, right? And yes. I think he said this. Listen, I think he said the same thing for January, and then March he said they're going to go probably 25. So I think he's laid out, but I also think it's imperative that he stays on that narrative.
Yeah, and I think the Fed is still a political animal, even though they claim they're not.
Right.
Take a look at the budget. We just hit $31 trillion for our national debt.
Right.
The price of paying that debt at the current interest rates is going to move that, just the interest carrying cost alone is going to move it from the fifth to the third highest expense of the national budget. That's gigantic. And if the rates keep going higher, it's going to soon pass Social Security. So we're talking about dramatic, terrible problems. And I think it's naive to think that the Department of Treasury, the White House, and Jerome Powell don't sit around and say, gosh, we got to do something about this before it gets out of hand.
Right. Well, and I think you're right. But I also think it's very interesting you say that because, and we've had this conversation, you and I, because back in 2021, in April of 21, when the CPI shot up from 1.6 to 3.1 in one move and blasted right through that 2% target, that was the signal then that they should have started very gradually they wouldn't have had to do the 675 basis point hikes. If they had started in April or May and gone 25 basis points consistently every month, then they may have been able to at least slow it down so it didn't hit 11% that it did on the PPI, or 9.3% on the CPI. But they didn't do that. They didn't do that, and they forced inflation, to 40-year highs. And so now they're behind the 8 ball.
Well, what do you expect from Mr. Magoo? I mean, these guys drive blindly and somehow keep on not crashing into things, but screwing things up.
Well,
the Fed has a long history of raising too late and tightening too much.
Yeah.
To me, the whole idea of 11 people pulling the financial levers and making everything perfect and saving the economy and combating inflation, it's ridiculous. It's as dumb as the wizard behind the curtain.
Right.
The 11 guys cannot do it, and they have a history of always doing it poorly.
Right. No, right. And I think that was always the concern, right? Because they overstimulate and then they over-tighten. And I like to use that pendulum kind of an analogy, right? Because the pendulum swings to the left where they overstimulate, and then it comes back down and it swings to the right. They can't bring it where it suddenly stops in the middle. It doesn't do that, right? The arc just brings it to the other way, which would be over-tightening. And I think that's really has been the concern. Now, they're talking once again about, they succeeded, it's going to be a soft landing. I still don't think it's going to be a soft landing, right? I still think that they're going to end up over tightening and it's going to be a little bit more of a hard landing. But listen, it's going to be what it's going to be, right? The smart investor just has to pay attention to guys like you that are identifying the trends, whether they are in the disruptor space or the dominator space. So talk about 2023. Do you have a vision of what you think is going to be the theme, or what you're looking at, or what you're thinking to look at?
Well, right before 2023 is Santa Claus time. And Santa Claus has historically been very good to the stock market. Take a look at these examples of what has happened in the past. 75% of the time, the market goes up between Christmas Day and January 2nd. Right. 75%. And usually pretty strongly.
That's right.
So that's a very, very strong historical indicator.
Santa Claus year-end rally, right?
Yeah. And so I think the immediate thing I want to talk about is, with all the strength we've seen in the market, with the Federal Reserve hints about things getting better in 2023, if you want to make some money today, get yourself in position to profit from that Santa Claus rally.
Exactly right. So let's talk about that. How does somebody do that in your view? Or what are you looking at? Where are the places to set yourself up? Sectors, not individual names, but sectors.
Sure. I think the easy way, just for the Santa Claus rally, is to buy yourself some ETFs that invest in either the NASDAQ or the S&P 500.
Yeah.
That's your quick, easy, short-term bet to make some money this holiday season. Maybe enough to pay for all those fancy presents you're going to buy for your wife, Kenny.
Okay, we're going to have a conversation about that. Yeah, go ahead.
So that's what first thing I do. Take advantage of Santa Claus rally. Take a look at the S&P 500 ETF or a NASDAQ ETF. Right. That's number one. But then number two, once we get into 2023, I think you want to take a look at some of those things that are on the 52-week low I talked about. That's primarily tech stocks. I'm not talking about the high flyers that only thing they have is eyeballs and unique visitors and page views and no profits. That's not the stocks you want to own. Right. Take a look at the ones that are beaten down. We talked earlier about Amazon, but Amazon, Google, Microsoft, these giant tech companies that have powerful franchises, they're going to be around for decades, are very worth taking a look at right now. And some of them pay very juicy dividends. So take a look at Microsoft, Amazon, Apple, Google.
Yep. But those are all, you see, when you say those names, Amazon, those for me, those are all foundational names. Those are names that you should own in good and bad times, in my opinion. I own them, and those are all names I own. And I will own them, and that's it. I'll just keep adding to them, and I'll own them.
Right? We're speaking the same language, Paisan.
But now, if you were somebody, let's move away from us, because we are of a different generation. Let's talk about somebody who's 35 or 40. They should be much further out on the risk scale than you and I.
Yes, they used to have that old rule: 100 minus your age is how much you have in stocks. I think that's too low, because somebody that's 40 years old should only have 60% in stocks. Right. I think that's too low.
Agreed. I think someone who's 40 years old should be closer to 90% in stocks. I actually don't think they should be in bonds at all at 40 years old.
No, I think there's other bond alternatives that you can look
Right.
at that'll give you better returns, like REITs,
Right.
or maybe some floating rate bonds, or even cash. Cash for years has paid nothing, zero.
Right. Correct.
But now you can actually earn 2-3% on your cash, so that's not bad.
Listen,
But
you
the
can go
re-
to the CD. Last week they were announcing you can go to a bank and get 4.5% for a 12-month CD.
Yeah, but you know the best thing about cash is bargains or no bargains. If you don't have the cash to take advantage of them, and so cash is really just a call option to buy something cheap in the future.
Correct.
So I'd rather have I'd rather see a 30, 40, 50-year-old have some cash than bonds so they can buy bargains.
Take advantage of buying the bargains. Yep, I agree. I think that's
And
a great idea.
So a lot of stocks heavily invested in the dominators with a sprinkling of the disruptors to make some big money. But that's where I think that you should go for 2023 when you're looking for your portfolio for the entire year.
Right. Are you thinking, what if somebody wanted to look, a 3-month T-bill is paying you just over 4%, a 3-month T-bill, right? A 2 year is paying you almost 4.5%, right? So you can put it there as well, but you got to tie your money up for 2 years. But if you're nervous, that's one place to put some money.
Yes, but keep it short because you want to buy some bargains.
Correct. So you want to keep it short. You're absolutely right.
2022 is a pretty tough year for most investors, right? Yeah. I mean, I've seen stats from Vanguard and Fidelity. Average 401k balances are down like 20% plus, and so a lot of people are shy about putting new money to work because of those losses and the tough 2022. But that goes back to that human psychology. You should buy when you're uncomfortable, not when you're enthusiastic and confident and brave.
Okay, but that's the key, right? People have to get used to being uncomfortable when they're investing money in the market. They have to, if they're doing it right, there's going to be some points where, okay, I'm a little bit uncomfortable with this, but I like the story, but I'm not sure, but I'm a little bit uncomfortable. But that's where you're going to get sometimes the big bang for your buck, right?
Yeah. You know, and but my point is that 2023 should be a very positive year for the market. You know, you got all kinds. You know, there's a Santa Claus rally. After the midterm elections, the returns following the down years, the more friendly Fed on the way, the monetary cavalry riding to the rescue. 2023 is going to be a positive year. And so you don't want to be overly cautious.
It's funny you say that because yesterday Goldman came out and they said 2023 is going to be a down year. Actually, we're going to close at 37.50 next year. That was Goldman's call. And Bank of America came out and said, you got to short tech in 2023. And I'm sitting there and I said, dude, that was the wrong call. You should have said that in December of 21 because tech is down 30+% this year. So you made the wrong call.
Wall Street's greatest skill is separating consumers from their money. So they're not there to make you money. They're there to make them money. So I don't care what they say. Take a look go back to that put call ratio. Who do you think's buying all those puts now? It's not the John down the street. It's Goldman and Merrill and all these big hedge fund guys. The guys that are supposed to know what they're doing are making giant bets, an overwhelming amount of bets for lower stock prices in the face of the Santa Claus rally, in the face of a more friendly Fed, in the face of rising profit. I just don't know why someone would want to run instead of buy.
Because again, I think like you and I said, it's the natural reaction when people get nervous, when the market's under pressure, people go, oh my God, I got to sell everything I own. Right? Unlike when Bloomingdale's has a sale and they mark everything 30% off, the women and men go running into the store because how could they leave it on the shelf? I got to buy 3 of those dresses because they're on sale. And I'm saying to myself, oh my God, use that same mentality in the stock market. When Amazon is down 40%, are you kidding me? Or Apple or IBM or Microsoft, some of these big, and look, I've been in the camp over the last year that as the market was uncomfortable and I was uncomfortable with the market, that you had to be, if you wanted to be in the market, you had to be in these big, boring, yet beautiful names. So what am I talking about? I'm talking about the big mega cap stocks that are not exciting and sexy, but they pay good dividends. They're large market cap. They'll sustain, they'll protect in the downside, right?
Absolutely.
And so that's a place that investors should think about. But let's get back to disruptors and dominators, because what's really exciting about this is not only how you identify those new names, right? Those disruptors, but then you have a stable of really the dominating names that add stability to your portfolio. So people that have been following you, people that have been subscribing to you, people that have been reading you, understand the benefit you bring to them.
Yeah, and let's talk about some dominators, but with a twist. If you take a look at the asset class performance in 2023, there's really only been one asset class that has delivered strong positive returns, and that's commodities. They've done very, very well, and I think that's not going to change. Part of that's inflationary, but I think most of it is the changing demands of our modern technology society. We're talking about lithium, uranium, copper, all these things that are going toward the green revolution are also involving commodities. So take a look at some of the very successful commodity producers. In disruptors and dominators, we happen to own Albemarle, which is the largest lithium producer in the world. I flew all the way down to Chile to visit their production facility in the Atacama Desert. And believe me, it was I think it was like a 32-hour trip to get there. It wasn't easy, but I saw with my own eyes on how profitable, how booming the demand is. There weren't very many Wall Street guys flying down there, but you know who was flying down there in droves? Automakers.
Yeah.
Volkswagen, BMW, they're sending their people, they're begging them to sign supply deals for many, many years in the future. So if President Biden and the green energy fans, they are going to put an electric vehicle in your garage, whether you like it or not.
Whether you like it or not. That's damn right. That's damn right.
And so invest in the lithium. But it's just not lithium. There's all kinds of commodities that go into producing electric vehicles or wind turbines or solar panels. And take a look at all of those.
But the exciting part about this for the audience to understand is that you identify those names, those sectors, and those stocks. And so people need to sign up. They need to follow you. They need to get your service so that they can be brought into the fold as well. Because Tony, you have an incredible, not only reputation, but an incredible performance chart. And so you've done really well, and people should understand that. And it's always a pleasure for me to have you on this show, to talk to you about kind of what's new in your mind, where you're looking at, what are you thinking at, because you're always spot on, and I appreciate that.
Well, I do like to talk.
Yes, you do. So Tony, until the next time, take good care.